So in the previous video, we covered the three different methods of depreciation. This slide here summarizes these depreciation methods and provides some kind of comparison. So as you can see here, we have the three methods: the straight line, the units of activity, or sometimes we call it the units of production method, and the double declining balance method. The useful life in the straight line is usually in years. In the units of activity, it's the units of activity. And the double declining balance, we again use the years. The depreciable cost is the cost less residual value under the straight line method. Under the units of activity, it's the same thing. Again, the cost less residual value. And the double declining balance, we use the declining book value, but not below residual value. So in the last year, remember, we have to just plug in a value that would bring the depreciation or bring the book value down to the residual value. How we calculate the depreciation rate in the straight line is just the straight line rate. In the units of activity, it's the cost minus the residual value divided by the total units of activity, and that's an estimate. And the double declining balance, we get the straight line and straight line rate, which is the same as the straight line rate calculation in the straight line method, and we multiply by 2. In the depreciation expense, in straight line, it's a constant. In the units of activity, it varies. It's variable depending on the units of activity. And the double declining, it's declining. And here we just have a note that the straight line rate is calculated as 100% divided by the useful life of the fixed asset. So here we have also a comparison between the values for the example that we had, and you can see in the straight line it was constant. And the units of activity, it varied depending on the number of hours that we used this forklift for. And in the double declining, it kept declining until the last year where we plugged in the value. One thing I want you to pay attention to is that the total value of the depreciation, whether we're going straight line, units of activity, or double declining, over the 5 years, they're the same. So whether we go straight line, double declining, units of activity, at the end of the day, or by the end of the life of the asset, the amount of depreciation is going to be the same. Here again we have a graphical presentation or comparison between the three methods, and you can see here that the green one is the double declining balance method. It gives managers an opportunity to calculate a huge amount of depreciation expense in the very first year, and then it keeps declining over time until the last year. You can see here it's very small compared to the other methods. The straight line, which is the blue method, you can see it's stable. But for the units of activity, again, it varies depending on the usage or depending on the output produced. Now let's talk about revising depreciation estimates. And accountants and managers, sometimes they change their mind. They buy an asset thinking it's going to be useful for 5 years, and then they realize that it can actually work for a couple of more years. So sometimes they decide to extend the life of the use of the asset, and sometimes they also revise the residual value or the salvage value of the asset. Can we do this? Yes, we can do this, but it's going to be prospective. In other words, from the point we make the change and on, we don't go back in time and change our depreciation expense. So what was recorded is already recorded. So the point that we decide to change the estimate, we have to recalculate the book value and assume as if this is a new cost, and then from that point we adjust the amount of depreciation expense. So we'll see examples for how this works. So estimates of residual values and useful lives of fixed assets may change due to abnormal wear and tear or obsolescence. When new estimates are made by management, they are used to determine the depreciation expense in future periods. The depreciation expense recorded in earlier years is not effective. So as I said, we do it prospectively, we don't do it retrospectively. So let's see this example. Assume the following data for a machine that was purchased on January 1st. So the initial machine cost was $140,000, the expected useful life was 5 years, and the estimated residual value is $10,000. So let's assume that we're using the straight line method here for simplicity. So we take the original cost, which is 140, minus the 10,000, which is the residual value or the scrap value, and that would be 130,000 divided by 5 years, and the amount of depreciation expense per year is going to be $26,000. Assume that at the end of the second year, the machine's book value or undepreciated cost is $88,000. And how we got this? Again, we agreed that it's $26,000 per year. It's for 2 years. So because it's the end of the second year, so we've been using it for 2 years. So we multiply that by 2 and the total accumulated depreciation would be $52,000. Deduct the $52,000 from the $140,000 and that would give us a book value, or in other terms, undepreciated cost at the end of the second year to be $88,000. So at the beginning of the third year, the company estimates that the machine's remaining useful life is 8 years instead of 3. Because remember, initially we thought it's 5, and then after the second year, we realized, you know what, this can work for more than 3 years. It actually can work for another 8 years. So in this case, we have to extend the useful life of the asset. And that is, the residual value is $8,000 instead of the $10,000. And they also assume that the residual value, instead of $10,000, it's going to be $8,000. So the depreciation expense for each of the remaining 8 years would be computed as follows. So we're going to update our value here. So we get the book value, and from the previous slide here, we've seen that the book value at the end of the second year was $88,000. So we'll assume as if this is the cost. So we take the book value minus the revised residual value. So it's $88,000 minus the $8,000, which was given here instead of the $10,000. And that would make us think of a new depreciable cost to be $80,000. The revised remaining useful life is 8 years. So that makes the useful life of the asset now 10 years. We already used it for 2 years and the remaining are 8 years. So 88 minus 8 is 80,000 divided by 8 years, that's 10,000 per year. So we went down from $26,000 per year to $10,000 per year. Why? Because we extended the useful life by another 5 years. So this is like graphical presentation to what happened to the asset. So this is the book value at the very beginning of its life, 140,000, and it used to decline by 26, and it was supposed to end up here, like in 5 years, but it was supposed to have a remaining book value of 10,000. So what happened is that we changed the slope. Now it's going only down by $10,000 per year, based on the new calculation that we just made here. And at the end of its useful life, which was after 10 years, we expect the residual value to be only $8,000. So you can see this is like a graphical presentation for what we have just done. Now let's talk about repairs and improvements. And this is something different from depreciation. However, there's a little part that affects depreciation, or affects the accumulated depreciation account. So once a fixed asset has been acquired and placed into service, costs may be incurred for ordinary maintenance and repairs. Think about your car. On a regular basis, you'll need maybe to do some kind of oil change, maybe some other tune-up as needed. So things like that are considered to be regular maintenance. So costs that benefit only the current period, we call them revenue expenditure. So these kind of oil changes are considered to be revenue expenditure. In addition, costs may be incurred for improving an asset or for extraordinary repairs that extend the asset's useful life. So let's say I have a car and I decided to install like a navigation system in the car. So that's something that's going to improve my car. So this is considered to be a capital expenditure. Or let's assume another scenario that I have an old car and I've been using this car for 10 years and now the engine is not that strong, so I decided to go for an overhaul. So I replaced the engine, or I had an overhaul for the engine. In this case, that's also a capital expenditure. Why? Because that's an extraordinary repair. It's not something that you do on an annual basis or on a regular basis. It extends the asset's useful life. So costs that improve the asset or extends its useful life are called capital expenditures. So now let's start with the ordinary maintenance and repairs and see how it works and the journal entries related to it. So costs related to the ordinary maintenance and repairs of the fixed assets are recorded as an expense of the current period. Such expenditures are revenue expenditures and are recorded as increases to repairs and maintenance expense. They have nothing to do with the cost of the asset or should not be recorded as part of the asset. we have to record them as part of the income statement. And I know the name might be confusing, like why we call it revenue expenditure. Why didn't we call it expense expenditure? I think it's just a term that ties the expenditure to what it generates in revenue. So we have this expenditure because it helps us generate the revenue. So this kind of expenditure or spending, we call it revenue expenditure. Unlike the other one, we call it capital expenditure. But ordinary maintenance and repairs, these are considered to be revenue expenditures. So let's see this example. $300 were paid for a tune-up of a delivery truck, and this is how it's recorded. We debit repairs and maintenance expense, and we credit cash. I want you to remember, once we have the term expense, this means that this account belongs to the income statement. So that's why this is a revenue expenditure. So that this journal entry is only affecting the income statement. Of course, cash here is the amount of cash that we paid for this tune-up, and it's going to affect the cash balance in the balance sheet, but the repairs has nothing to do with the fixed asset. Or in other words, has nothing to do with the delivery truck. It's only regular or ordinary maintenance and repairs. Now let's see the extraordinary repairs, something that we don't normally do. So after a fixed asset has been placed into service, costs may be incurred to extend the asset's useful life. Such costs are capital expenditures and are recorded as a decrease in an accumulated depreciation account. So that's a little bit different scenario here. It's unique because it's something that's going to extend the asset's useful life. Instead of adding this expenditure to the cost of the asset, we just reduce the amount of accumulated depreciation. So we decrease the accumulated depreciation. Yet, it's still considered to be a capital expenditure. So let's see an example. So the engine of a forklift that is near the end of its useful life may be overhauled at a cost of $4,500, extending its useful life by 8 years. The expenditure is recorded as follows. We're going to debit accumulated depreciation for the forklift and credit cash. I want you to remember, accumulated depreciation is a contra asset account. We normally record it on the credit and we debit depreciation expense. But because now we had this kind of extraordinary repair, we want to record this kind of reduction in the depreciation by debiting the accumulated depreciation. So we're actually reducing the value of the accumulated depreciation. And on the other side, again, we have the cash, which is the amount of cash that we spent to fix or overhaul the engine. So because the forklift's remaining useful life has changed, depreciation for the forklift will also change based on the new book value of the forklift. Now let's see an example for an asset improvement. And here, after a fixed asset has been placed into service, costs may be incurred to improve the asset. Such costs are considered to be capital expenditure and are recorded as increases to the fixed assets account. So any kind of expenditure that improves the asset, we're actually going to add it to the value of the fixed asset. So let's see this example. The surface value of a delivery truck might be improved by adding a $5,500 hydraulic lift to allow for easier and quicker loading of cargo. The expenditure is recorded as follows. So notice here we are debiting the delivery truck, even though we're not buying the new delivery truck, but this is something that's going to add to the value of the delivery truck, and that's why we're debiting the delivery truck. And on the credit side, we just have cash. Again, this is the amount of cash that we spent in order to add this hydraulic lift. So the hydraulic lift is adding value to the truck. So because the cost of the delivery truck has increased, depreciation for the truck will also change over its remaining useful life. Now we have to incorporate the value of this forklift that has been added to the value of the truck, and this is going to change the amount of the depreciation expense. So this slide here just summarizes the idea of how we make the decision for these kind of expenditures. So costs related to fixed assets, if it's only affecting the current period, so benefits only current period, then we consider that to be a revenue expenditure. And what we do is that we debit repairs and maintenance expense and we credit cash. If it benefits current and future periods, so in other words, it has some future value or it's going to improve the asset beyond just one year or beyond the current year, then we have to make the decision between two things. Is it considered to be an extraordinary repair, or is it an asset improvement? If it's an extraordinary repair, the nature of that is that it extends the useful life, like overhauling an engine. In this case, we just consider that to be a capital expenditure, and we debit the accumulated depreciation. If the benefit for the current and future period is considered to be an asset improvement, something that adds value to the asset, like adding a service value to the asset, and we had the example of having this kind of forklift. The lift gate, or this kind of additional to the truck, or addition to the truck. In this case, it's also considered to be a capital expenditure, but we're only going to debit the fixed asset. We're not going to debit the accumulated depreciation. So let me stop here. In the next video, we're going to be talking about discarding fixed assets, and we'll see how we can get rid of the fixed assets and remove them from the financial records.